Wall Street is no longer just powered by capital, it's powered by code. Artificial intelligence has become the heartbeat of the US stock market. From trading algorithms to trillion-dollar valuations, AI now drives not just innovation, but investor psychology itself. Every rally, every dip, every whisper on the trading floor seems to circle back to one question. How big can AI really get? In 2025, the answer seems to be as big as Wall Street dares to believe. Over the past year, AI has transformed from a tech buzzword into the market's main storyline. The Nasdaq hit new highs, the S&P 500 reached record territory, and nearly all the momentum came from a small cluster of AI-linked stocks. Nvidia, Microsoft, AMD, Alphabet. These companies aren't just leading the market, they are the market. Analysts estimate that just 7 AI giants now account for over 60% of total S&P 500 gains this year. That level of concentration hasn't been seen since the dot-com era. But unlike the internet boom of the late 90s, this time the excitement isn't about websites or e-commerce. It's about intelligence, machine intelligence, that promises to redefine productivity, automate industries, and multiply profits. For investors, this is both thrilling and dangerous. Let's start with what's fueling this AI mania. Wall Street's logic is simple. AI boosts efficiency, and efficiency boosts earnings. Companies that integrate AI first can cut costs, move faster, and scale smarter. JP Morgan says it spends $2 billion a year on AI and claims the cost savings alone nearly offset that amount. Dell just raised its long-term forecast, citing surging AI demand. Microsoft completely restructured its leadership to center around AI commercialization. The entire economy is being rewritten around one assumption: that AI will drive growth for the next decade. That belief has turned into a financial tsunami. Capital has flooded into any stock with an AI narrative, from chip makers and cloud providers to data analytics firms and robotics startups. The result? An unprecedented rise in valuations. Nvidia's market cap passed $3 trillion, briefly rivaling Apple's. AMD shares surged after signing a massive chip deal with OpenAI. Even companies only loosely connected to AI have seen their stock prices explode. But beneath this gold rush lies a sobering truth. Wall Street isn't betting on profits today, it's betting on potential tomorrow. The numbers look good on paper, but many of these AI investments haven't yet produced real, measurable returns. A growing number of analysts warn that the AI boom has inflated expectations far beyond fundamentals. Goldman Sachs's CEO recently cautioned that the market could face a drawdown if those expectations don't materialize. In simple terms, he's saying, the air in this balloon might not hold forever. Still, the reason investors keep pouring in is because AI is transforming more than just companies. It's changing how markets themselves operate. More than 70% of US trading volume now runs on algorithmic systems, and a large portion of those systems are AI-enhanced. These algorithms analyze massive data streams, news headlines, earnings reports, even social media sentiment, and execute trades in microseconds. That gives large firms extraordinary speed and predictive power, but it also makes markets hypersensitive to data shifts. When AI models all react to the same signal, a rate cut, an earnings miss, or a geopolitical event, the result can be violent swings. The same systems that fuel gains can amplify losses. That's why many insiders quietly say the next market correction won't come from human panic. It'll come from machine logic. For long-term investors, this raises critical questions. Is AI driving sustainable value creation or just accelerating speculation? Are we witnessing the foundation of a new economic era or the beginning of another bubble? Let's break it down. The bull case is powerful. Unlike the crypto or meme stock frenzies, AI has genuine utility. It's transforming logistics, healthcare, design, and finance. The productivity gains are real. When applied correctly, AI can eliminate inefficiencies, boost innovation, and create entirely new revenue streams. That's why giants like Amazon, Google, and Meta are doubling down. For them, AI isn't a gamble, it's an inevitability. But the bear case is equally real. Building AI isn't cheap. It requires massive infrastructure, chips, servers, data centers, and energy. Power costs are skyrocketing. Data center construction is hitting record levels. And many smaller firms jumping into the AI race don't have the resources to sustain that pace. They're burning cash just to stay relevant. Even for the big players, AI development eats into margins. If profits don't rise as fast as costs, Wall Street's patience could fade quickly. That's when the hype turns into pressure, and pressure turns into panic. This is where the risk for investors lies. When markets concentrate too heavily on a single theme, they become fragile. Right now, most of Wall Street's growth narrative depends on AI. If that narrative breaks, if earnings disappoint, if regulation tightens, or if one major company stumbles, it could trigger a cascading reaction across sectors. We've seen this before. In 2000, it was dot-coms. In 2008, it was real estate. In 2025, the risk could be artificial intelligence. That doesn't mean investors should run away from AI. It means they should be smarter about it. The best approach is to separate AI reality from AI hype. Focus on companies that are generating real revenue from AI applications, not just talking about them. Look for firms with strong balance sheets, data advantages, and clear paths to profitability. Avoid the ones that rely solely on buzzwords or future promises. It's also crucial to diversify. AI touches everything: chips, software, hardware, energy, manufacturing, logistics. Investors who spread exposure across the ecosystem, rather than piling into a few tech giants, will likely weather volatility better. Finally, understand that markets move in cycles. Today, AI is the story everyone wants to believe in. Tomorrow, that story might shift. The winners will be those who stay grounded, who ride the innovation, but don't drown in the enthusiasm. AI is here to stay, but hype isn't. For now, Wall Street is betting that AI will rewrite the rules of business, economics, and productivity. It might. But history teaches us that every revolution comes with corrections, and every boom tests its believers. So as investors celebrate the AI era, the real question isn't how high these stocks can go. It's how strong the foundation underneath them really is. Because if Wall Street has truly become one giant AI bet, then the future of the market depends on whether the machines deliver or crash the system they've built.